Okay, let's unpack this. We've been looking at material from some, well, very experienced bullion insiders, and they're calling it a complete structural breakdown in the silver market.
Yeah, it's pretty stark language. This
Yeah.
isn't just forecasting a price rise. It's talking about a radical repricing event.
Exactly. Silver potentially surging and fast past $140 an ounce. That's the claim.
And it's framed as a system failure, not just, normal market swings. We're focusing specifically on Andrew Maguire's analysis here. He's got deep roots in the bullion trade.
Right, and he's pointing to technical and physical evidence suggesting the whole paper control mechanism, the one that's been around for decades, is basically imploding.
The signals he highlights are pretty alarming. Global stuff. China clamping down on exports.
London's vaults reportedly, what, empty?
Pretty much, yeah. Absolutely bare is the quote, I think. And the cost to borrow silver, the lease rates, have spiked enormously, up to 30%.
Okay, so our mission in this discussion is really to examine that evidence Maguire presented. Why are these signs of a structural failure, not just a blip?
And how is Asia apparently grabbing control of the physical pricing? What does that path to $140 actually look like, according to him?
We're trying to synthesize all this complex data, the futures backwardation, the delivery issues, to really get why he's saying the paper market is, quote, out of ammunition.
It's a lot to digest.
It is. And if you rely on getting this kind of unique, timely analysis on major market shifts, make sure you hit subscribe right now. You won't want to miss these explorations. Okay, let's start with those immediate stress signals. Maguire points to several big red flags. Severe physical tightness right now. Let's start overseas. What was that specific move by the People's Bank of China? How did that squeeze global supply?
Well, the key thing is it was an intentional policy move. The PBOC put in new silver export controls.
Like turn off a tap.
Exactly. It acts like a tourniquet, effectively locking that physical supply inside mainland China. And that just instantly cuts off a huge source of bullion for Western markets.
And you see the immediate fallout hitting London, the traditional heart of the paper market. What's the crisis there specifically?
It really centers on these obligations that, well, they can't meet them. Maguire's reporting London's physical silver vaults are absolutely bare.
We hear that term, loco London obligations. What does that mean in practice?
These are basically paper claims against metal that's supposed to be held in London vaults. A lot of these claims were used to hedge short positions, but now people are demanding the actual physical delivery.
And the banks don't have it.
They literally cannot cover them, according to this analysis. It's a scramble.
Sounds like a classic supply panic. And you see that reflected in the borrowing costs, right? That spike in lease rates is, well, it's
Oh,
shocking.
absolutely. It screams acute distress right now. Lease rates, the cost to borrow physical silver for urgent delivery, they just spiked massively.
Way past 24%, even over 30%.
Yeah, those are the reports. That kind of spike is just a crystal clear signal. Lenders see the huge risk in lending out scarce metal when they might not get it back. Physical is becoming unreliable collateral.
So this shortage leads to this really weird market disconnect Maguire highlights. Spot silver hits all-time highs in every major currency.
Every FX cross, yeah. Yuan, euro, rupee.
Except the US dollar. How is the dollar price still being held down if the physical market globally is screaming shortage?
Well, that is the core manipulation mechanism being discussed, isn't it? The
Yeah.
fact that the US dollar price is the lone outlier. It tells you where the leverage is being applied.
So the COMEX futures market.
Reportedly, yes. Massive, unbacked, short positions placed there. They're so large they suppress that nominal dollar price, even while the real global price, measured physically in other currencies, is taking off.
So the other currencies show reality, the dollar shows the paper debt.
That's the argument. And even regulators seem to be noticing the increased risk, maybe quietly. What did the CME do recently?
They did nudge up margin requirements, didn't they?
Yeah, quietly. Gold margins went from 17K to 18K, silver from 16K to 17K.
Which basically means it costs more to hold those positions.
Right. Raising margins is what exchanges do when they see the risk of big price swings or defaults getting too high. It's like a subtle regulatory nod that, yeah, the pressure on the shorts is building up dramatically.
Okay, so the physical signs are flashing red. Let's look at the paper plumbing itself. Maguire insists the COMEX LBMA system isn't just stressed, it's structurally broken. What's the most damning technical evidence he points to? Why does he call it unprecedented?
I think the single most compelling piece is the backwardation in silver futures. It's unprecedentedly deep.
Explain backwardation simply again. Price today is higher than price in the future.
Exactly. The price for getting physical silver right now is higher than the price for delivery months or even years down the road. It's the opposite of how commodity futures usually work.
And how far out does this backwardation stretch, this desperation for immediate metal?
According to Maguire's analysis, it goes as far as July 2028, 5 years out. Yeah, think about it. It's like paying a massive premium for food today, even though, the next harvest is years away. It signals absolute desperation for current supply.
And he says the scale of backwardation 5 years deep didn't happen even during the Hunt brothers squeeze in 79-80.
Correct. That's what makes it unprecedented.
Yeah.
It's just irrefutable evidence, he argues, that the futures market structure is completely broken. Immediate physical access is everything now.
And this disconnect must also be creating a huge gap between the paper price and the physical price people are actually willing to pay.
Yeah.
How does that show up technically?
It shows up in something called the EFP basis spread. EFP stands for exchange for physical. It's basically the difference between the futures contract price and the immediate spot price.
And that spread has widened.
Dramatically. Reportedly nearing $3 an ounce at times. Per contract, that's a difference of like $15,000.
$15,000 difference per contract.
Yeah, it's a huge gap. It just illustrates how artificially mispriced COMEX silver is compared to the global physical reality. It's a direct measure of the failure to efficiently link paper and physical.
Okay, so if the Western paper price mechanism is breaking, who's setting the price now? Where is the real discovery happening?
The argument is that control has decisively shifted east. Specifically, the Shanghai Gold Exchange, the SGE.
Ah, Shanghai.
Yeah. Maguire's analysis indicates the SGE is now influencing every other global silver FX cross. Its physically settled spot market is, quote, shaking this COMEX tail.
So Shanghai prices are effectively setting London's spot prices now.
We're seeing SGE prices consistently setting the local London spot prices, yes. That's presented as proof that London and New York have lost control of global price discovery to Asia's physical demand.
And this physical exhaustion isn't just theoretical, right? We saw tangible impacts, like with those big Indian investment funds.
Yes, that's crucial confirmation. Major Indian funds, Kotak Mahindra, UTI, SBI, they actually suspended new subscriptions to their silver ETFs. They cited one simple reason. They couldn't source enough available physical silver bullion at current prices to back the new ETF shares they would need to issue.
Wow. When the big institutions running massive funds say they can't buy the metal.
You know the shortage is real. It's not just traders talking.
Okay, this is pretty granular, but understanding these mechanics is key. If you're finding this breakdown valuable for seeing how global finance works, or maybe doesn't work anymore, take a second right now and hit that subscribe button. It really helps you stay informed as these huge shifts play out.
All right, we've got the vanishing supply, the cracked paper plumbing. What's the ultimate forcing mechanism here? What's actually driving the collapse of this paper system? And why does Maguire land on that specific number, $140 an ounce?
The core of the crisis, as he lays it out, stems from just massive historical leverage, decades of it.
In what form?
It's these historically accrued, naked, unallocated foreign exchange, silver derivative bets, basically huge over-the-counter derivative contracts. Bets on the price of silver, supposedly hedged, but maybe not really. And primarily handled by who?
Fed agent banks, mainly. Names like JP Morgan and Citi come up frequently in these analyses.
Okay, so these old, massive bets, they're being exposed now.
Precisely. They are reportedly being actively called in, meaning the holders are demanding physical delivery against these paper claims.
And that's what exposes the whole structure.
Yes, because according to Maguire, it reveals the LBMA CME derivative structure as completely naked. The physical metal supposedly backing all these bets. It just doesn't exist in the quantities required.
Which puts the banks on the hook.
It creates an existential threat of default for, he identifies 4 key clearing banks, JP Morgan, UBS, ICBC Standard, and Standard Chartered. They hold massive paper obligations they apparently can't physically meet.
So to avoid a default, maybe even a systemic banking crisis, they have no choice but to cover those massive short positions.
They are forced to cover. But how? London's vaults are supposedly empty.
They have to go into the open market and buy physical metal.
Exactly. They must buy back their huge unallocated paper exposure with real physical silver.
But the physical market is incredibly tight, as we just discussed. Spiking lease rates, ETFs suspending purchases.
Which means the only way to entice enough physical bullion onto the market to satisfy that enormous short covering demand is at much, much higher prices. ex exponentially higher, potentially.
So Maguire says the old high around $50, $53, that was just a temporary stop, a staging point.
Yeah, merely a staging point in this view, not the final destination.
Okay, but why $140? Is that just a guess, or is there a logic to that specific number?
His assertion is that $140 isn't arbitrary. It's the calculated equilibrium price needed.
Equilibrium for what?
It's the level where the immense short-covering demand from these potentially failing banks finally meets sufficient new physical supply coming to market.
So it's the price needed to incentivize miners to produce more, or holders to sell.
Both. It's the price required to bring enough high-cost mine supply online and, crucially, to persuade holders of existing physical bullion, maybe sitting in deep storage, to finally sell it into the market to meet that massive institutional delivery demand.
So $140 isn't just a wild prediction. In his analysis, it's the price mathematically required to clear the massive derivative debt and fix the physical supply shortage it created.
Exactly. It's presented as the price needed to force a global repricing of silver, marking a definitive shift away from the dollar-dominated paper derivative system towards a physically settled global reality. Hashtag outro.
Okay. We've really broken down this entire warning. The unprecedented technical signals, the backwardation, the lease rate panic, Asian taking control, and this huge derivative short position that supposedly mandates a $140 price just to clear the books. If you had to boil it down, what's the single key takeaway from this analysis for the listener?
I think the core message is structural, and it's urgent. It's that the final phase of what Maguire calls the silver reset is happening now. It's a transition, a fundamental shift from synthetic futures setting the price to physical settlement driving it.
And the paper market.
Is confirmed, in his view, to be out of ammunition. Can't control the price anymore.
So for investors, people trying to navigate this, what's Maguire's direct practical advice?
It's very straightforward. Focus purely on possession. If you don't hold it, you don't own it.
Meaning physical metal is key.
Absolutely. Given the delivery failures described and the supposed nakedness of the derivatives, the focus has to be on acquiring actual physical metal. And probably avoiding over-leveraged paper instruments like maybe some ETFs that might not have full backing.
Right. So zooming out just a bit, what does this tell us about precious metals overall? We often lump gold and silver together. If silver is facing this kind of structural collapse, does that mean anything for how it might move relative to gold?
Well, gold is certainly part of the same big picture shift, the unwinding of derivative debts, response to geopolitical stuff, monetary pressures. But silver's market is just much, much smaller, thinner.
Less liquid.
Far less liquid, yeah. And that smaller market size means its reaction to these kinds of massive short-covering forces. Well, the prediction is it will be far more explosive than gold's reaction. Gold will move, but silver could move much more violently.
So the provocative thought for people listening is,
Are you positioned for a market that's just having a strong rally? Or are you prepared for one that might be about to fundamentally break and reset its entire price discovery mechanism? That's the core question Maguire's analysis forces you to ask.
a very powerful thought to end on. Thank you for walking us through Andrew Maguire's urgent warnings about this potential structural failure in the silver market.
Glad to break it down.
And for everyone listening, if this exploration gave you valuable context and insight, please do hit that like button, subscribe if you haven't already, and maybe share this information with others who need to hear it. Until next time, stay sharp.